Or maybe he doesn't. He just fucked up somewhere.
Yeah. You think it's more likely that he got information on her than just been? She said you got cold feet.
Could be a combination of both. He could have just got caught cheating.
Yo, I'm in the booth.
Yo, 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 yo. Yo, yo.
Yo.
Waiting on Powell, man.
Good old Powell party here, boys.
Yes, sir. About to play something from the YouTube. Either some lo-fi, see who's live. While we wait the hour for it to get started.
All right, sounds good. Damn, the girl forgot to put my growlers in the.
Oh, you ain't got them?
I'm so busy trying to
With
give me
base
one of
44, a simple sentence.
The samples was papers with the strip art.
Yeah, that's the graphic.
Yeah.
Yeah.
Gotcha.
Oh no, I got one.
You got him.
Say, man. Yeah, I got it. Golden boy. Yes, sir. Nasdaq holding up. Everything's selling crazy.
Yeah, Tech. I'm not surprised. Tech should be strong.
Only thing strong is AMD really. I mean, tech is
The chips
Nvidia is pretty
underlining.
high.
Yeah, the chips underlining doing all right because the chip trade in China is back too. The AI trade in China back too.
Oh wow.
Yeah, so that's mainly it's just AMD over here right now, but China was damn near out of the AI conversation. Now they fully back. Whatever index they use to track it, it's been up 14% this week.
Oh wow. Yeah. Good. I guess tech is going good. You look at these damn prices. Yeah, still something.
Yeah, still selling.
Yes.
Yeah. Yes,
Yes, and hit today.
playing that previous day low. So it played out. Played like the weather said.
All right, I'm here, boys. I'm rolling up.
Yeah, me too. I got trading fraternity. He live right now, so we're gonna hang out there for a little bit.
All right, perfect. We here.
All right, we here.
About to pull up on this one.
All right, cool.
The last
Right off the
Jerome
bat,
Powell.
you should be having a long term. And it's little by little, and that's going to grow. Again, it's already worked in every scenario. I have not been on, again, that sometimes we've had to eat some shit for a little bit by being small, by buying, and then it rips, and we're like, oh, we wish we had more. I would have made this. We've done all that. We've had to buy shit and it not move for a couple months. We got to go negative, but all in all, when you every year it goes up and it's going up at a great rate. So it's like it's gonna work. It's gonna grow your capital. The high quality. Go look at the latest trading fraternity video, the one where I buy Oracle. I explain quality. I give my indicators, and then I use somebody greater than me, Benjamin Graham, so you could kind of understand. But it's a company that's been in business for 10 years and will most likely be in business for another 10, makes a certain amount of revenue. Like, things like that make something quality. But if you really wanted to dumb it down and simplify it, it's been around for 10 and it'll be around for another 10. That's, again, the best sign of quality is it's already successful. It's already done well. And that's why, too, you don't really even need to invest in the next big thing. Most of them you already know about and they're successful. But think about even that little Jim Rohn. You want to give money to somebody who has proved that they make money. And they're going to use your money, your capital, and they're going to keep making money with it. And then you get your cut of it. Oh, it's great advice on not selling prior to being in escrow and inspections. I thought it was guaranteed. It wasn't. I backed out with no regrets or stress. Fuck yeah, dude. I wish you know. I want you to get a house, but yeah, dude, good fucking work. I'm glad you listened. Most people, that's one of those things that you would have had to learn the hard way, but that just saved you the tax liability and you caught all the gains too in the meantime. You could have lost too though. You know what I'm saying? Like, your long term could have went down in that process, but you know, that's kind of but there's also the risk of the property too, and at least you didn't feel like you were forced to do anything. But yeah, dude, I like that. Good review. Trump asked Netanyahu to work more carefully and not bring down buildings in Lebanon because it would damage their image. We're working to prevent the collapse of the ceasefire in Lebanon during the next 2 weeks and beyond.
This year, Stocks, Europe's leader in index innovation, is excited to celebrate 15 years of thematic indices. From themes such as breakthrough healthcare and energy storage, to artificial intelligence, quantum computing, and many more. Stocks thematic indices provide investors with access to transformative trends. Find out more at stocks.com.
But I don't think so. I don't. This has been reverse splitted and diluted many times probably, but I don't know much about it. But yeah, I don't know if it will get back to the previous $380 billion high. I don't know. I didn't count all the digits, but I'm just eyeballing it. Jay Powell, go over a quick preview in like 15 minutes, like right before. So yeah, I have simple. I don't even have a document for you, but I do think it's pretty simple today. I got one good thing though. I got one potential statement change, and then I have a good elephant in the room that I don't think people are addressing. Might be a good time. Might be a good time.
Mumbai, my long term. Kumbaya, Kumbaya, my long term. Kumbaya. Stonks go up, my friend. Stonks go ooh. Dips get bought, my friend. Dips get bought. Kumbaya, my long term.
Oh, it's looking good for shorts, but I don't know if I want to stay in for FOMC, bro. I got a limit. I'm scared. But I'm
Damn, I feel you.
just in case they do some trades. Yo, what's the deal?
Feel you, bro. I was looking at those. I was looking at shorts from our 10 o'clock stream. I put it on in practice because we had picked that loss early. That shit is CG3.
Yeah, man, it's looking good for some shorts, good. I don't know if I want to lose this limit on that, bro. That's on the
Live for the 140 man.
I might have to take it off, bro. I can't afford this. Yeah, I'm probably just catch the momentum. Like, after the 231 releases, then I'll look for a trade if I can continue. If not, I'll just trade tonight.
talk to you.
Just wanna talk to you. Just wanna talk to you. Then I realize, oh, I realize that you are somebody.
Woods here. Got it set up on the stream. He looking short. You in a trade, Max Woods?
Introducing Iron Beam, the best choice for futures trading. Iron Beam is the industry-leading broker catering to traders worldwide. With the free Iron Beam platform and free real-time data, you can trade the most popular futures contracts anywhere and from any device. Low day trade margins, free depth of market, hundreds of indicators, and trading directly off the chart. Makes your trading more powerful than ever.
Yeah, I'm here, Brody. What did it say? Fed votes 8-4 to hold benchmark rate 3 to 5, so they decided to hold, and then a headline: Fed Moran dissents in favor of a rate cut.
Wow.
Is that the replacement of Moran?
Nah, that's just somebody on there. Somebody that voted. That's their comments.
All right, cool.
Powell speaking already? He's speaking right now.
You speaking already?
Yeah, it's on right now.
And that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last September through December, we lowered our policy rate 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between a half and three-quarters, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut from most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so
equities are falling. Yep. I think, let me see if Max is in short. I'll wait till Powell's done, actually.
one, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Howard.
We all want more progress, more wins. But what we
just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
Powell's last speech, boys.
Part of it, but that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well, but yes. But no, there's also just the feeling that we haven't seen, the.
What an age, 50 years.
And on tariffs and on the rest of it, so for whatever reason people did write up their inflation forecast, that will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy. It just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
The consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow.
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not. It's just you got to write something down, and this is something that is that people wrote down. And we don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that just because you don't know it's so unclear what the direction from this particular end.
Crazy or not? If that one doesn't go crazy.
The growth has been solid, and inflation.
Also, there's a thing, bro. I can't even.
From
I
the
could
goods
close
and
my trades like
tariffs.
15 minutes.
And the labor market is the unemployment rate, of course, has not changed since September. You have a very, very low break-even rate apparently for new jobs with little growth in either demand or supply. But the U.S. economy is doing, pretty well. It's just we don't know what the effects of this will be, and really no one does.
And you got to close 15 minutes before to make sure you don't get hit with the overnight market.
15 minutes before the close.
Mr. In the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about.
Yeah, I didn't know that. It's good to know with our account.
Domestic production.
Be on the same shit, to make sure it's closed.
It might be the same on trade
is happening right now.
Yeah, and I found out what it was. Ninja Trader bought TraderBase, so it's
The
literally
original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'll be an offset.
Offsets, yeah.
So that's true. We have, we're a net exporter of energy rights. Any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and you're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation...
Getting the echo, boss. Make sure your desktop mic is off.
Looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations. And so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, I think it's important that we do that. Very important.
Nick. Tamaros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting.
You got to have the best to be the best.
Balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is continued, what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward. Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality, and I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
You know, it's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. You know, in a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think a good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent really, growth in the labor force, which of course we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but you know, I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So you know, we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless it's something we're watching carefully, and you know, are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks, and you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing, and a much more difficult thing, because it does immediately raise the question of tension between the 2 parts of our mandate. But you know, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But you know, there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just
if there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's 1 percentage point above that. So calling that stagflation, it's not. I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean because we see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. In the Middle East are contributing to a high level of uncertainty about the economic outlook, and we will remain attentive to risks to both sides of our dual mandate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment.
Implement NetSuite because of the complexity of the business. I have 5 times as many people outside of finance using NetSuite as I have within finance.
There's one mistake that kills more traders than bad analysis or psychology, and it's not what you think. I've developed a
2% over the 12 months ending in March. This relatively high rate largely reflects the effects of tariffs on prices in the goods sector. near-term measures of inflation expectations have risen this year, likely because of the substantial rise in oil prices. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. The economic outlook remains highly uncertain, and the conflict in the Middle East has added to this uncertainty. In the near term, higher energy prices will push up overall inflation. Beyond that, the scope and duration of potential effects on the economy remain unclear, as does the future course of the conflict itself. We will continue to monitor the risks to both sides of our dual mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis.
There we go.
This is my last press conference as chair, and I will close with a few thoughts. First, I want to congratulate Kevin Warsh on his advancement out of the Senate Banking Committee this morning. This is an important step forward, and I wish him well as that process continues. The Federal Reserve exists for one fundamental purpose: to foster the economic conditions in which American families and businesses can thrive. Stable prices, a strong job market, and a financial system they can depend on. Every decision we make, whether about interest rates or regulatory and supervisory matters or other issues, is made in service of that purpose. Our decisions reflect the collective judgment of the Board of Governors and the Federal Open Market Committee, colleagues who demonstrate analytical rigor, principled judgment, and a genuine commitment to the public interest. Our collaborative and deliberative process has long reflected a shared commitment to finding common ground in service to our mission. This institution is resilient, capable, and staffed by professionals of extraordinary talent and exceptional dedication. It has been a privilege to serve alongside so many great public servants at the Board of Governors and around the Federal Reserve System. The Fed's work is only as effective as the public's understanding of it, and you, the press, are essential to keeping the public informed about what we do and why. The people we serve benefit from your careful reporting. I welcomed the announcement last Friday by the U.S. Attorney for the District of Columbia that she had closed the criminal investigation. She also noted, however, that she would not hesitate to restart the investigation. Over the weekend, the Department of Justice provided assurances that they will not reopen the investigation unless there's a criminal referral from the Fed's Inspector General. And, absent such a referral, if they do appeal the recent court decision, they would not seek, as part of that appeal, to restart the investigation or send new subpoenas. I've said that I will not leave the board until this investigation is well and truly over, with transparency and finality, and I stand by that. I'm encouraged by recent developments, and I'm watching the remaining steps in this process carefully. My decisions on these matters will continue to be guided entirely by what I believe is in the best interest of the institution and the people we serve. After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined.
Wow.
I plan to keep a low profile as a governor. There's only ever one chair of the Federal Reserve Board. When Kevin Warsh is confirmed and sworn in, he will be that chair. Once sworn in as board chair, his new colleagues will elect him to chair the FOMC as well.
Wow.
As I regularly point out from this podium, our success in delivering our goals matters for all Americans. I'm confident that the Fed will continue to do its work with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Aww.
Thank you, Mr. Chair. Appreciate the kind words about the press. Often doesn't come from the podium in different places, but appreciate that. Can you talk about what is gone into your decision to remain on the board? What kind of criteria are you weighing, and how long might you stay? Thank you.
Sure. So, my concern is really about the series of legal attacks on the Fed,
right,
which threaten our ability to conduct monetary policy without considering political factors. And I want to note here, this has nothing whatever to do with verbal criticism by elected officials. I've never suggested that such verbal criticism is a problem, and neither has anyone else here. But these legal actions by the administration are unprecedented in our 113-year history, and there are ongoing threats of additional such actions. I worry that these attacks are battering the institution and putting at risk the thing that really matters to the public, which is the ability to conduct monetary policy without taking into consideration political factors.
Right.
It is so important for our economy, for the people that we serve, that they can depend over time on a central bank that operates that way, free of political influence.
Good for you.
It's part of the absolute foundation of this amazing economy that we have. It's just one of the many reasons why the U.S. economy is the envy of the world.
Hell yeah.
That piece of institutional architecture separates successful countries from unsuccessful countries.
Yep.
It is extremely important, not for the people who work at the Fed at any given time, but for the people that we serve, that the Fed remain able to conduct monetary policy in a way that doesn't get pulled into politics, trying to help or hurt any particular politician or political party. It's critical for the people that we serve. In terms of when I would leave, I will leave when I think it's appropriate to do so. Was that all your questions, or was that?
Well, I just have a follow-up, which is, what would you say to the criticism that by remaining on the board, you're actually taking a political act and denying President Trump the majority of the board, which as president he would have if you left?
I don't see that at all. And as I mentioned, I'm literally staying because of the actions that have been taken. I had long planned to be retiring, and the things that have happened in the last 3 months have I think left me no choice but to stay until I see them through at least that long. In addition, I don't see how this will interfere. My intention is not to interfere. I was a governor for almost 6 years, and the tradition is at the Fed that governors who understand how difficult the role of chair is, and as a soon-to-be former chair, I do understand how hard it is to get consensus with 19 strong-minded people. You work with the chair. You try to be heard, but also collaborate with the chair and try to support the chair when you can. When you can't, you can't. And I think that's the attitude that people generally take, and that's the attitude that I'll take.
Good for him. What a badass to actually stand up to these attacks, though. He's actually fighting for what political institutions should be.
In March, you described the standard practice of looking through energy shocks as conditional on inflation expectations staying anchored. Since that meeting, there has been very little progress reopening key energy trade corridors. Can you help us understand how the inflation outlook has changed in the intermeeting period, beginning with the prospects for tariff pass-through resolving on the timeline that you had outlined in March, before getting to the energy shock that is now on top?
So, I would look at it this way. For a long time, we've been working on the hypothesis, really, that tariffs would lead to a one-time price increase and that would go away over time. In other words, that there would be no further change, so measured inflation wouldn't reflect that higher level going up more and more. And it's time for that to happen. We really do expect that to be happening in the next 2 quarters. So we'll be watching very carefully to see that what we've thought all along would happen. That's the kind of critical part of the forecast. We need to really see that. With energy, it's so hard to say. I mentioned, in sort of the textbook, you would look through an oil shock because they tend to be short-lived and they tend to revert, and monetary policy works with long and variable lags, so you wouldn't necessarily react right away. I think that is all the more true given that we're several years above 2% inflation and that we're already looking through the tariff shock.
Yeah, you're right, Teddy. Good comments in the chat. I agree with you.
But the question about looking through energy really is not in front of us right now. It hasn't even peaked yet. And I think we'd want to see the backside of that and progress on tariffs before we even thought about reducing rates.
So if I could follow up, the statement today preserves language that has taken on some meaning as it was socialized when the committee was actively lowering rates. Why is that easing bias still ripe, given how different the inflation outlook is now versus a meeting or two ago? And what more would have to happen for it to get evicted?
So that was as you will recall, we had a discussion about that at the last meeting, and we talked about it in the press conference after the March meeting. We had the same today. We had quite a vigorous discussion about that very issue and the guidance, and is it still appropriate, and that kind of thing. And I would say that the number of people on the committee who either could support that language changing to a more neutral stance so that a hike is as likely as a cut, that number has increased over the intermeeting period.
Wow.
And it's easy to see why. I mean, it's a good question, right? You see inflation has moved up over the interim a bit. Core inflation is 3.2 now, moving, albeit just a little bit, in the wrong direction. And we know that there will be, that there's headline inflation coming out of the Gulf, and we don't know how much that will be. We're going to need to see. So it makes all the sense in the world that people would look at that, and we'd have a vigorous discussion about that. You saw that 3 people dissented over the language. I think all of those people agreed with the rate decision. So the majority of the committee did not want to do that, and I didn't think we needed to do it at this meeting. It really was just a question of why do we need to do that now? We have so much to learn. There's so much uncertainty about the path ahead. There doesn't need to be any rush to make that decision now.
Right. No rush is a big thing that we've been talking about. And Teddy, in the comments here, you're right on. I mean, really, these shocks after shock keep inflation elevated for the shorter period of time. Hopefully by 2032, my goal, rates are way down again, which probably will be. But like Jerome Powell says, no cuts basically until we get through this oil and tariff shock.
Claire.
So Claire Jones, Financial Times. Just going back to this issue of the easing bias, we've now got oil approaching $120 a barrel when it comes to the benchmark.
That's the number.
Brent crude. If it stays around those levels 6 weeks from now, what would be your best guess as to whether the easing bias will still be in the statement? Thank you.
Hold.
I wouldn't want to guess. Well, first of all, we're going to have new leadership in all likelihood by then, and new leadership's going to have a very important role to play in that. So I won't be standing here at this podium to answer your question. So I don't know. As I mentioned, that's all I can really say is that we had a great discussion about that today. It's gotten to be a better question in the interim period. We had the discussion. A majority are still on the page of not feeling the need to move to that level, and that's where I am.
Yeah.
I get it, though. At a certain point, you would move, and that conceivably could come as soon as the next meeting.
Thank you.
Wow.
Just to follow on, the new leadership also seemed
conceivably move as soon as next meeting. I don't think they're going to move. I think they're going to hold. You don't want to pull a 1970s and really screw with people's expectations, which really affects inflation as well.
Today here, but I think communications generally is. I think every incoming chair takes a look at communications, and it's a very healthy thing. I mean, communications it's very complex, and you can always be looking at new things. And if that happens, feels like it's going to happen, that's a completely appropriate thing.
Hi, Chair Powell, Neil Irwin with Axios. Can you tell us if you've been in touch with incoming Chairman Warsh? To what extent is this a normal transition process versus all the things swirling around, something unusual, and what can we expect when he takes that podium in a few weeks?
I haven't seen him since seeing him at a dinner in January where I congratulated him and had a nice chat with him. Haven't seen him. I don't know what a normal process is. The last process was with Janet Yellen, with whom I had worked for 6 years, and so it was. We were sitting down the hall from each other, so it was a very different thing. I think this is and will be a very normal, standard kind of a transition process. So that's what I expect. I have every reason to think it will be.
Quick follow-up: is the Supreme Court ruling on Governor Cook a factor in when you may leave as a governor?
I wasn't thinking of it as such, but no, not really. I mean, I'm thinking more of the other things I mentioned.
Hi, thanks for taking our question. I wanted to ask a question about your tenure, and Chris Rugaber at Associated Press.
Who's the blondie?
During your tenure as chair, you often spoke about how disadvantaged Americans benefited from extended periods of low unemployment. In the new framework the Fed adopted in 2020, some economists say elevated the Fed's employment mandate. Are you worried that the pandemic inflation spike that followed will make future Fed chairs more reluctant to pursue a hot jobs market? And should they be?
No.
I don't know the answer to that. I mean, what we experienced in the teens, the mid-teens, was really low levels of unemployment for a long period of time and no reaction from inflation. And we all very much took notice of that. We also noticed that the biggest wage gains were going to people at the bottom end of the income spectrum. And we had many, many reports of, it felt like a fairly stable equilibrium, and a lot of benefits were flowing to people at the bottom end of the income spectrum, including companies were, setting up in people who were confined and like training them before they got out, and it was a very healthy sort of set of societal
less
dynamics.
so now.
So of course, I think anybody would love to get back to that.
Yeah.
I don't think that anything that happened to create the global pandemic inflation was in any way related to overweighting the employment market. I mean, it was a global shock that happened essentially very, very similarly all over the world. It had to do with closing, reopening, stimulus, and all that. And
Yeah.
I mean, you could look at a graph of 10 big economies on the page and not know which was the U.S. and which was Germany, France, and things like that. So I don't think that insight was in any way responsible for the high inflation that we experienced. So, I mean, I think it's always been a balance. You've got to be strong on both of our dual mandates, and for example, now we don't feel that the labor market is at all a source of inflation, so we don't need to be worrying about that. It's been a long time since we have had to worry about that. Well, actually, during the pandemic recovery, the labor market was super overheated and tight, and that's when we had to worry about it, but not now.
And just on the other issue, do you need more assurance from the Justice Department before stepping down? Is that what you're waiting for, or what else?
I'm
is
waiting,
gonna affect
for the investigation to be well and truly over with finality and transparency, and I'm waiting for that, and I will leave when I think it's appropriate to do so.
Yeah, fair. Quick reminder, since it's his last meeting as Fed chair, coupon code Goodbye Powell is live, both at meetkevin.com and househack.com if you want that real estate AI. Valuation AI comes out at the end of June.
View and interest rates, because there were some members of the Open Market Committee who've been suggesting that we may need to raise interest rates even absent the war because inflation was not coming down fast enough. Is there any sense that interest rates might have to go up, or was this just a setup to sort of warn people that you're worried about the war impacts?
So the three dissenters and others who could have supported that, and others who were voters and non-voters who preferred it, they all supported the rate decision, right? So people are not saying we need to hike now. It's more a question of, don't we kind of feel that we should be neutral? And what are markets doing? People argue that this is consistent with markets are doing. And again, it's a very fair question, but these changes, it's a form of forward guidance, and you want to make them in a way that will be sustained and continue to make sense, and not something you need to take back, fairly quickly. So I think we just a group of us, including me, didn't feel like we needed to be in a hurry on that. That markets are not confused about our reaction function. We don't have a problem to solve on that. But the other side of the argument is a good argument too, as I mentioned. It's a perfectly good argument to be having, good discussion to be having. So, and it came out the way it came out.
Well, you've got three dissents in favor of two-sided warning. You've got yourself staying on the board. You've got the criticism that does come from elected officials, and you've got a lot of critics who have faulted the Fed for being too slow 2021 with inflation. Are you worried about Fed credibility under all of this? Is that one reason that you want to stay on?
Not driving my thinking now. I mean, monetary policy is going to get made by, 19 people. There's a lot of stability there. I mean, if you think about it, every new Fed chair has the same situation, which is you've got 18 colleagues on the FOMC, 11 of them vote during any year, and your job is to create consensus. It's to talk to them, understand them, be inside their thinking, and be able to pull them together and get consensus and move. And that's what every Fed chair has to do. And I think Kevin Warsh is actually quite well. He has the capabilities, skills to be very good at that, I would think. So I think I'm not so worried about that process. I think that'll work itself out.
Thank you, Chair Powell. Howard Schneider with Reuters. You mentioned that staying on as a governor, you intend to keep a low profile. I'm just wondering if you could give us a little more detail on what that looks like and how you can. Touche. Walk down the steps. What that looks like, and particularly around the policy discussion, how you're able to have your intervention and not be a shadow chair and not have a kind of an outsized influence over the process.
Yeah, that's just something I would never do. The shadow chair thing. No, I don't know what the exact specifics of it will be, but I'm going back to being a governor. I respect the role of chair. I was a chair. I was a governor for 6 years, and I know what that's like. I know, and I had a pretty front row seat particularly with Chair Yellen, to whom I was close when I worked with Chairman Bernanke for 2 years, but. I was brand new at that time. So I got a sense of what it was, and I had real sympathy for how hard it is to get that group to consensus. And I always felt like I don't want to add to that unnecessarily. And that means try to support the chairs where the direction the chair wants to go in, if you can. If you can't, you can't. And I think that's the way it's always worked there, because the chair only has one vote, plus the ability to develop consensus. And if people won't be they won't, if they're not flexible at all, then how do you ever do that? And so that's why the chair has, the authority the chair has really is to develop relationships with people and work with them and then put something forward that has consensus. And I propose to be a very constructive participant in that process, really out of respect for the office of the chair.
And in your view as a soon-to-be governor, how do you see the risks of oil prices bleeding into core inflation in coming weeks? Because it seems like the commentary that was coming from particularly some of the Reserve Bank presidents, they were elevated concerns about the bleed into core. And, here we are with 3 dissents now. What do you see as the prospect of a core inflation?
Those prospects are real. Remember, though, and the real thing is we're going to have to wait and see. We're going to need to see. And the good news is we think our policy stance is in a very good place for us to wait and see. We're right kind of at the high end of neutral or perhaps mildly restrictive. The labor market shows more and more signs of stability, whereas inflation is kind of misbehaving. And so maybe a little bit of restriction or the high end of neutral is just the right place to be. So we can wait here and see how things work out before we act. And we'll see how much how much does come through into core. You see it already in airfares, of course, but you may see it in many other places. We just don't know yet, and it's so unknowable because how long will the strait be closed? You can develop any number of scenarios that you want, but we really won't know till we know. So fortunately, we're in a good place to wait and let things develop.
Thanks, Mr. Chairman. You started holding post-meeting press conferences for every meeting as opposed to the ones with SEPs. Can you talk about why you see that as a net positive?
So we always said when we were doing quarterly press conferences, we always said we can move at any meeting, but we only ever moved at the quarterly SEP meetings where we had the press conference. So if you think about it, during the pandemic, we were moving like a lot at every meeting and sometimes between meetings. And doing that without a press conference, I think, would have been quite challenging. It's become the industry norm. It's the standard. I don't know whether that has to remain that way. I don't know. I mean, it's just something people have become used to. And I do think it's quite helpful I try to deliver a message on behalf of the committee rather than 18 other people going out and delivering their message. And it's going to be all over the place because we do, thankfully, have widely disparate views.
Okay, thanks. The other thing I wanted to ask about was the communications review from last year. Could you describe the debate last year, what changes were considered, what you wanted, and what prevented any action on those changes?
So I'm not going to go into the real small specifics, but What we found very quickly was that making changes, making really large changes, for example, to the dot plot or the SEP, it didn't have, we couldn't come up with anything that had really broad support on the committee, and so we just didn't, we didn't really do as much on that as we might have. And you know, I was never the world's biggest fan of the dot plot, but you can't beat something with nothing. And you know, we've looked at a bunch of things, and you know, it's something, like I said, I think every new chair is going to look at our suite of communications and think about what would be changes. We are the only major central bank that doesn't publish a forecast. And that's because we have a 19-person committee, and you know, you try to do that at the board, that's hard. At the committee, that's hard. It's hard if you do it at the staff. So it works. I think our communications are fine, but looking at doing it in a different and better way is the most natural thing in the world.
Thank you. Colby Smith with the New York Times. If I could follow up on Mike's question about hikes, are we right to assume that the hawkish outcome for the Fed is still one in which the committee just extends the pause in rate cuts?
Yeah.
And to what extent is there a growing sense within the committee that monetary policy really isn't just restrictive at all right now? The economy is holding up relatively well despite this major energy shock. The unemployment rate has ticked lower.
Right.
Inflation was moving sideways
Good question.
even before the war and is now moving higher. So where is the committee at on that debate?
Yeah.
You know, where we're at is we think our policy rate is in a good place. If we need to hike, we will certainly signal that, and we will certainly do it. And if we need to cut, then, or if it's appropriate to cut, then we'll signal the opposite. I think because we feel like we're in a good place to move in either direction. Nobody's calling for a hike right now, so it really is going to depend on how things evolve, and you know, that's really where it is. And as I mentioned, much closer question this cycle on changing the guidance, but ultimately we didn't.
And as it relates to the war, at what point do you think the risk to growth will be larger than the risk to inflation as this conflict drags on?
You know, you just have to find that out empirically. You know, given our the fact that we're, you know, a big exporter of energy, and that our economy is far less energy intensive, oil intensive than it was during the 70s. You know, the effects on the United States are really substantially less than those of Western Europe or Asia, who are feeling much greater effects from these things. The effects we're feeling in the current situation currently, and in sort of what's priced in, which is you know, a relatively quick outcome. If this goes on for much longer and prices go much higher, then we'll feel that much more. And of course, I'm talking about aggregate inflation numbers. We're very well aware that people are experiencing higher gas prices all over the country now, and that hurts. And those hikes may continue to happen. And other things are going to start to reflect airline fares I've mentioned, and other products and services that are dependent upon petroleum and derivatives of petroleum. People are going to start to feel that.
Edward.
Thank you, Chair Powell. Edward Lawrence with Fox Business. So I guess I'll just ask you directly on this. The markets don't see a rate cut at all this year, is what they're predicting. Do you think that we are at the neutral rate? Why or why not?
You know, the neutral rate is we cannot know it with certainty. I think pretty close to the neutral rate. Yeah, I always had it, you know, between 3% and 4%. We're a little north of 3.5%. So that's well in the range of what I would consider a reasonable, but at the higher end of the range of what I would consider reasonable neutral rate. You know, I think the labor market is still probably cooling off just a little bit, and I don't think there's much of a case for any case really for policy looking, you know, meaningfully restrictive, maybe mildly restrictive or neutral, I would say.
And I want to follow up on some of the other questions about your future a little bit. The first time we've seen 4 dissents now since October of 1992, are you handing off a divided Fed?
You know, the thing to remember is we have always had vigorous debates, and they're excellent debates. I have to say they've been really good, and we're in an unusually difficult situation. So we've really had 4 supply shocks. You can say more than 4, but at a minimum, we had the pandemic, we had the invasion of Ukraine, we had tariffs, and now we have Iran and the oil, the oil spike. So every supply shock has the capability of driving inflation up and unemployment up. And what do? Central bank has a really hard time knowing what to do. So the right thing to do is to try to balance the achievement of those 2 goals, and that's what our framework calls for us to do. But these are really tough, difficult judgments. You've got to have a forecast for each variable. You've got to think how long it's going to take to get back to target. You got to think how restrictive or not is policy. So it's only natural that you have a range of views on the committee. People are going to see it different ways. They're going to have different risk tolerances and that kind of thing. I mean, if everybody agreed, that would be surprising. And I think it's partly a function of the extraordinarily challenging set of supply shocks that we've been dealing with now for 5-6 years.
Thank you so much, Chair Powell. Selena Wayne with ABC News. Are you confident that Kevin Warsh will stand up to political pressure from President Trump?
So he testified very strongly to that effect in his hearing, and I'll take him at his word.
And when it comes to gas, right now it's over $4 a gallon. Inflation just hit a 2-year high. Should Americans expect to be paying higher gas prices for the rest of this year? And in your view, does that take a rate cut off of the table? And secondly, by staying on as Fed governor, what message do you think you're sending to the president?
I don't know what gas prices are going to do for the rest of the year. And it will depend on how long the strait remains closed and how quickly it can be reopened and that kind of thing. But remember, when gas prices go up, that's disposable income coming out of people's pockets, so they're going to spend less on other things. So there will be a hit to GDP. So it's a question whether spending goes down to offset the inflationary effects. So it's not the answer isn't obvious ex ante whether you should move your rate over because of that. We'll have to see how it evolves.
And the message is to President Trump by staying on?
I'll stand on what I said earlier.
Victoria. Hi, Victoria Guido with Politico. During your tenure, Fed independence has come under pressure in a lot of different ways. And I was just wondering, practically speaking, where do you see Fed independence as coming from? Is it the law? Is it political support from Congress? Is it the actions of the Fed? What sustains Fed independence?
Well, it's to a significant extent, it is the law. And, we've had to go to court to successfully so far to defend it. But, the law does create a setting in which the Fed can and is directed to make monetary policy without consideration of political factors. And so part of it is the law. But it goes beyond that, though. There's a set of customs. There's a boundary line between the Fed and the administration, between the Fed and the Treasury Department. And we need to continue to respect those boundaries about what the Fed is responsible for and what the Treasury is responsible for and what the rest of the administration is responsible for. So some of it is legal. In fact, it's all legal at the end of the day, but it's more than just monetary policy. We don't want to use our tools we haven't wanted to use our tools to achieve goals that are really clearly outside our mandate. Every administration looks at our tools and thinks that would be good to repurpose those to serve other purposes, but that's dragging us into politics and into fiscal policy. So we've resisted that.
Well, and maybe another way of asking it, too, is do you think that Fed independence is as strong now as when you became chair? And if so, why?
Look, I think it's at risk. I mean, I think these legal assaults, if you will, as I mentioned, the institution is being battered over these things. We're having to resort to, the courts to enforce our legal, it's not so much independence. It's really the ability to make monetary policy without political considerations. that's what we're talking about. And we've had to do that, and we've been successful so far, but that's not over. None of that is concluded yet. And it's, it's really important. It's not about people who work at the Fed or the institution. It's about the benefits of a central bank that makes decisions based on analysis and our best thinking, rather than trying to help or hurt politicians. It's that there's a bright line between central banks who do one and do the other, and successful countries have uniformly, successful advanced economy countries have a really strong set of protections around their central bank just for that reason. So that's what it's all about. I think I am confident, as I said in my remarks, that the Fed will continue to make its decision based on analysis, rigorous analysis, and not on political considerations. But we've had to fight for it, and I'd like to think that I'd like to think we can get out of that era and go back to respecting, what the law says and what custom has been, which is to, let the Fed do our thing. It's an institution full of human beings who work super hard to get things right for the benefit of the public. We're all human. Don't expect for perfection, but do expect us to make, decisions without political considerations.
Standing ovation, please.
And the very best analysis we can bring.
Good, dude. End it on that.
Katerina.
Damn. That was good.
Katerina Saraiva, Bloomberg News.
Damn.
How would you characterize what you've heard from your colleagues on your decision to stay? Do you have their support? And then have you heard concern from your colleagues about continued legal attacks from the executive branch? Is this something that others have, talked to you about?
So I think that I don't want to report on what my colleagues think. They can speak for themselves. But there are widespread concerns that these things may continue. That's all I'll say. And and that would be a problem. And
no, Scott.
So.
I didn't mark it.
And then I just also wanted to ask about Governor Waller's speech on the reserve banks. Do you have any thoughts on centralizing some of those functions in the way he described? And then are you concerned that something like that could potentially be a slippery slope to,
well said, Teddy.
To consolidate reserve bank functions even more in such a way where the central bank ultimately loses some of that important regional information?
So we try to be good stewards of the public's money and efficient, and Chris Waller is particularly passionate about that. Of course, so are the presidents, and it's a question of how do you accomplish it. We of course, and Chris said this in his speech, we want 12 strong independent central banks with their own staffs and their own monetary policy views and all that. But there are things that are done in all 12 which could well be done at one much more efficiently and with cost savings. And so there's a back and forth going on that, but everybody's on the same page. The other thing he touched on was the idea of removing reserve bank presidents from office over different views on monetary policy, and I would just agree with him so strongly that would be the beginning of the end of the Fed's ability to make monetary policy independently. If every administration could come in and do that, you're just another cabinet agency at that point. So that's not something that I would support. Chris said the same thing.
Yeah.
Christine. Thanks, Chair Powell. Christine Romans, NBC News. I want to ask about legacy. When the history books are written, how do you think your stewardship at the Fed will be remembered for the past 8 years?
I'm going to just say that that's for someone else to say. I'll give you a mulligan on that.
All right. I'm going to ask you about misbehaving inflation then. You talked about those 4 big shocks, supply shocks over the past 5 years, and inflation still misbehaving. What's your message to American families who feel like inflation has not been under control for them
job's not done.
Really since the COVID reopening?
Job isn't done.
We're committed to bring inflation back down to 2% and sustainably. That's our goal, and we'll stick at it until that happens. We keep getting these events keep happening, which keep driving up costs, and the best thing we can do is to use our tools to guide inflation back down to 2%. I think trying to get there really quickly could be very costly in terms of of job loss and things like that.
Right.
But we try to get there over time in a way that does the least damage possible. And, our commitment to that is never ending and unshakable.
How would you describe the economy outside of the misbehaving inflation? I mean, it's still awfully resilient given all of the blows.
I don't know that you can be awfully resilient. So it's actually quite resilient, I would say, because it's a positive thing. If I can have that amendment, yeah, the growth is really solid across our economy. Some of that is that consumer spending is hanging in pretty well. The most recent data are good. And some of it is just the apparently insatiable demand for data centers all over the United States. So a lot of business investment going into building data centers, and every reason to think that that continues. So you've got an economy that's growing at 2% or better. PDFP, which is private domestic final purchases, which is really a better signal of a momentum in the economy, is actually higher than that. So that's a positive thing. If you look at the unemployment rate, it's 4.3%. So that's a low rate. That's pretty close to mainstream estimates of the natural rate. We've been there for a long time. So it doesn't feel like a good labor market to some who don't have jobs, because quits are really low, hires are really low, and there's effectively no new net job creation. So that's in a sense, the labor market is in balance. But it's an unusual and uncomfortable kind of a balance where people who don't have jobs will have a hard time breaking in unless somebody quits their job.
Yep.
So that's pretty good. Inflation is the thing we need to work on, and it's partly tariffs, which we think that inflation should subside over the course of this year, because it's kind of a one-time increase. It shouldn't be repeated, and that should start happening pretty soon. The energy inflation that we're getting should go through fairly quickly. And we'll just have to see how that works out. In the meantime, we think our policy stance is in a good place for us to hold and wait developments.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. At the risk of beating the dead horse here, clearly 3 members objected to keeping that easing bias in the statement. And you said that the majority still didn't need to move to new language at this point. So does the majority of the committee still have a bias towards cuts at this point, or has the bias on the committee shifted away from cuts towards holding or hikes if that was needed?
So I think that, the center is moving toward a more neutral place, and that's sort of what markets are saying too. I just think, there's a lot of signaling going on when you change guidance like that. And so we just, I guess a majority of us didn't feel like we needed to send a signal on that right now. But maybe it'll come to that. And the reason is because, we're kind of waiting to see what happens with events in the Middle East and what are the implications of those events for the U.S. economy. So there's a group who feels like we don't need to be in a hurry to do that. We get it. And of course, we will move to a hiking bias if we want to hike, and we'll move to a neutral bias before that. But there was a difference over whether to do it at this meeting, at a meeting at which all but one of us agreed that the rate decision was correct, which was not to move.
And you just said moments ago that you believe Fed independence is at risk. Is it safe to say that you want to stay on as a governor to serve as a check and balance on that?
I want to stay until I will stay until I feel it's appropriate for me to leave. And yes, that is really what is driving this.
That's fair.
I'm not looking to be, a high-profile dissident or anything like that. I'm more looking at the other aspects of this and wanting to see that things have calmed down and we're returning to a traditional model of working with the people that you have and bringing them to consensus and respecting that consensus. That's what I'm hoping to see.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. You've made many tough decisions in your time at the Fed, and as your time as chair comes to a close and you think about your tenure and perhaps your legacy, are there any decisions that stand out as ones that you're particularly proud of? And are there any that, with the benefit of hindsight, you would take a mulligan on?
Yeah, it's hard. I wouldn't want to single out individual things at this point. I'll just say, we, all of us together, have consistently tried to do what we think is best for the American people based on our tools and our objectives that Congress has given us. It's been very challenging because we've been in a situation of supply shocks really for 6 years. And that's just a very different situation than, for a very long time, what the Fed and other central banks were doing all the time was demand management. And, and there was always the inflation mandate, but inflation was low for 25 years. So this is a very different world and a much more challenging one where you have to balance the two objectives. And by the way, central banks that have an inflation mandate have to do exactly the same thing because they're balancing economic activity. So that's been challenging, and we've tried to do our very best through these really challenging times, and I'm really proud of the work that I've done, that my colleagues and I have done during these years.
Now, to follow up on some of the discussion around Fed independence, can you explain to the public why this notion of Fed independence, which might sound kind of wonky to some, is so critical? I mean, what are the consequences if either the Supreme Court rules against
such
Lisa
old news,
Cook,
unanchored inflation expectations, blah, 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 blah.
make decisions more...
End it and give them a standing ovation.
So every major advanced economy in the world has made the same decision the United States has made, and that is that they want to take the making of monetary policy, the setting of interest rates to support the economy, to achieve maximum employment and price stability. They want to take that out of the direct control of elected politicians. And the reason is elected politicians are always running for election, and they'll always want low rates, and that will lead to inflation over time. Right. So after literally centuries of experience with that, the whole world moved to the different model, and it's worked great. I mean, this is the era in which inflation was under control for 40 years. Then we had the pandemic, inflation everywhere in the world, and now we have inflation that had gone pretty much all the way back to target, really close to all the way back to target, and now is being buffeted by the energy shock, and the U.S. buffeted by the tariff shock as well. So, but what I would say to the general public is that's the backstory, is that
stop the count.
Don't think about it, an institution being independent. Think about it this way, that you want people to make monetary policy and set interest rates to benefit the general public and to try to achieve economic goals, which are maximum employment and price stability, and focus only on that and ignore political considerations completely. Ignore them. This isn't bipartisan. This is nonpartisan. So we want to just work directly for the American people doing these things. We don't think, oh, I want to do this because the president says it's a good idea, or because there's an election coming up and I want to speed up or slow down the economy. I mean, think about that. If that's what we were doing, we'd have no credibility. Markets would lose faith in us, and our ability to control inflation and have any respect would be gone. And let me say, whatever people say, the markets believe in that we will produce 2% inflation. If you look at longer run expectations, markets believe that there's no sense in which our credibility in the markets has weakened. It's just not the case. It's people do get it, that this is our commitment and that we will achieve it, and it's priced in. If you disagree with that, then you can go ahead and bet against the markets, but the markets are pricing in Fed credibility.
Yeah.
Okay, we'll go to Richard for the last question.
Last question.
Thank you, Chair Powell. Richard Escobedo with CBS News. We talked a lot about gasoline prices and even you mentioned airline ticket prices, both of which are up dramatically because of the war in Iran. Oh. And so I wonder, are you seeing that weigh down consumer spending in other parts of the economy? And if so, how worried are you that that will be a drag on growth?
You don't see it in spending yet. You really don't. I mean, as one of your colleagues said, the economy has been resilient. It really has. Not just this time, but it's been remarkably resilient for some years now. The U.S. economy has just powered through shock after shock, and consumers are still spending, and that's what the banks will tell you, credit card companies will tell you, the retail sales numbers that we got most recently. Yep. People are still spending, and how long can that go on in a world where if gas prices were to go up a bunch more, that's taking otherwise spendable money out of people's pockets. But right now, we don't actually see much slowdown yet, certainly none from this. But you think logically you will, because people have a certain amount of money to spend, if they're spending 25% more on gas or something like that, then that's going to come out of other spending. But we don't see it yet.
One last thing. You mentioned those economies in Southeast Asia that are particularly dependent on petroleum. They make a lot of the stuff that American consumers buy. So was there any discussion today about whether or not those costs getting passed along to consumers is a real concern, and whether or not that might push up inflation?
So all of those things are in there, are in the models that we use to calculate inflation. So they're just parts. You can ask about anything like that, and they have a place. The staff has a place where they're looking at that and pricing in what will happen with higher prices and that kind of thing. So it's there. The effects are not that big yet. We're a huge economy. The import sector is only 10% of the economy, so we're not like a European country where 50% of the external of GDP is in the external sector. We're also, as I mentioned, we're an oil exporter, so we're not feeling the same kind of pain, and we're not likely to feel the same kind of pain that economies in Western Europe and certainly in Asia are feeling. Anyway, thank you very much, everyone.
Standing ovation.
I won't see you next time.
Aww.
Well, following his final Fed meeting as chair.
Well, that was it. Jerome Powell's final press conference as Fed chair.
Just close the fucking door.
Man, he's going to be missed. But there's good news. We have a lot to talk about what Jerome Powell just said, and a special coupon code called Goodbye Powell before we raise prices with some amazing new updates coming.
Peace out, Powell, man. End of an era, boys. Our first Fed president. Like, that's kind of crazy. That's going to be historic for us. Like, that was the Fed when I first started trading. Oh yeah, you're gonna be close to the Fed, I'm sure, huh? Damn. Wow. He went out with grace, bro. That was very nice. Gave the market a little rally and everything, huh? Yeah. That's crazy, bro. Yeah. Pretty crazy. Yeah, he can't. I mean, that's literally the main mandate, one of the main mandates of his job, to keep it House and State separate, keep that separate. Take him to the hokey pokey. Nice. All right, cool. We're here. Still here with you. All right.
Coming out in May for the Meet Kevin course, and then in June for househack.com. But for now, let's focus on the Federal Reserve. It is over, and we are going to cover at the end of this segment a report card on Jerome Powell. We'll talk about his bullishness on the economy. We'll talk about rate cuts and a bar that he sets for rate hikes, which is also bullish and kind of important. We'll talk about Powell leaving versus not leaving, transitory inflation, all the good stuff. We're going to try to keep it short and just stick to what was different this time. So one thing that was different this time is we had an 8-4 vote, which was the least amount of consensus that we have seen since October of 1992. Myron voted for a cut of 25 basis points. That's the only reason he seems to exist anyway. Although, he does have some sound logical arguments for continuing to cut and ensure that labor market doesn't break through as it sort of has been trending down, though recently stabilizing. And Hammack, Kashgari, and Logan really voted for a decline because they wanted to remove the easing bias from the statement, which it's almost, you really have to kind of read between the lines to get it, but basically in their statement, the implication is, hey, we're going to wait on the extent and timing of additional adjustments as we assess incoming data. And so they wanted a little bit more of a clear, hey, we're just not going to do anything until the oil shock clears, which in fairness is probably one of the worst or most complicated issues we face now. I have sort of a warning bell that starts ringing that I've been paying attention to since, Brent was $95 with course members. I'm like, look, we start getting to 120 on Brent crude and markets are going to slowly start reacting to that. That's why this Monday I went into markets. I'm like, we're at 665 on the Qs. Probably not the week for calls. Markets on the Qs right now are slightly green, but we're at 661. So we're still down from where we were Monday. Let earnings happen. Let's get through some of this volatility. Right now, Donald Trump is prepping us, and this was wild. This was happening during the Fed statement release. Donald Trump apparently telling us that he thinks the war in Ukraine might end before the war in Iran, which is literally the last thing you want to hear. We saw oil move up another 3 or 4 percentage points after those comments, which now push us at 119, which is just $1 away from my alarm bell. And practically, just to give it to you straight, the reason I call 120 the alarm bell is not because it's some recessionary threshold. It's not. It's just that's when everybody starts talking about it again. And the more people start talking about it, the institutions start complaining about it. Oh my gosh, if we get to 130 or 150 or this, that's usually when you start getting more of that hedging and selling. So it's sort of like an early alarm bell to where you get institutions getting a little bit more nervous, which could lead to less of that rush to buying stocks. Especially when the CNN greed and fear, I really hate even using the name CNN, but the greed and fear index right now is at greed. It wouldn't be unreasonable for you to have a miss at a certain company in earnings over the next 2 or 3 weeks, see a little bit of a pullback. And this is despite the fact that I've broadly become more bullish on economic data since the war has begun. Our bull-bear scale is almost at 7.5 right now, and a lot of that is based on underlying economic data, whether it was the capital goods spending that we saw this morning, ex-air, ex-military spending, obviously a lot of that artificial intelligence, or just the stabilization and growth that we're seeing in the labor market, even on private payroll surveys. Now, Jerome Powell did pick up on that as well. In fact, he said PDFP, which is one of his favorite measures, is actually growing faster than what we're seeing on some of the GDP numbers or even the numbers that we got this morning. Commercial purchases. That stands for private domestic final purchases. It's sort of the Fed's preferred measure for how the economy is growing. And he argues that PDFP indicates that the economy is actually growing better than a 2% rate. And he actually acknowledges the pain that people have, which is if you don't have a job right now, or you've just lost your job, or you've been unemployed, or people who are unemployed, you don't feel like the economy is good. You feel like a crappy place or a crappy situation, which is totally reasonable and fair because it's so much harder to get a job now. And you're sort of waiting for somebody else to lose a job to hopefully fill that seat. And so that has made the labor market less desirable for people, but it's also created less labor market inflation, which is ironically good for the Federal Reserve in reducing some of those inflationary pressures, especially since, as Powell put it, we've been dealing with shock after shock after shock. Whether it was Ukraine following COVID, or now recently the Iran shock, or what we saw in 24 or 3, we had a banking crisis for a period of time, right? There's been a lot. So anyway, this dissent, though, where there's this talk about removing the easing bias, in my opinion, does set up a little bit of a harder time for Kevin Warsh, who will be coming in May 15th as the Fed chair. And then, of course, we have our mid-June, I think it's the 19th, mid-June will be the next FOMC presser. And I'm a little sad because I've been covering Jerome Powell, honestly, for 8 years. It's weird. You know, I said if he sticks the soft landing, I got to put a statue in my yard of Jerome Powell, you know, with some kind of like smug arms crossed face, maybe with like a hard hat on, you know, for the Jerome Powell Trump meeting. Somebody apparently is going to email me their info on making a bronze bust. You know, I'll go for bronze or stone or whatever. You know, we need we need Federal Reserve marble. Anyway, you could email me if you ever have questions on the courses or you ever have questions, whatever, just email us.
Email staff@meetkevin.com. Data dependent.
Right. Anyway, so I do think that it is getting a little bit harder for the Federal Reserve to create consensus because there's a lot of talk about, hey, like, we don't know how long this oil shock is going to last, the direction of the Strait of Hormuz, the direction of, consumer spending. Consumer spending is holding up. Jerome Powell echoed what we heard from bank earnings, JP Morgan, Wells. We've covered that on the channel, that broadly the consumer spend is holding up as it has been really since COVID. And so the question is, how much longer can consumers keep spending through these higher oil and air prices or whatever? And so far, it's been resilient. Now, of course, part of that is probably because the biggest spenders are higher net worth or even middle net worth individuals who have exposure to the stock market, which has been very bullish over the last few weeks. We called on buying calls and going bullish literally the day of the ceasefire. And I think I had this mountain of people complaining, saying, Kevin, you're an idiot. Stocks are going to go down even more. And I'm like, oh, the more these comments complain, the more I think I'm right about this call that we're going straight up. And we did. The call is straight up on hardware, went straight up. AMD is up like 50%. Soxel was up like, 126%. And I think the next move after hardware, even though we might have a little bit of a dip here in the near future with these oil prices, will be software, but that could still be 6 months out. You got to get that SpaceX IPO. But anyway, I do think that when Warsh comes in June, it's going to be a little harder for him to try to bias towards cuts because people at the Fed, these voting members, they don't want to cut right now. They want to hold. Holding is really the bias. And so Jerome Powell argues that he's likely going to stay at the Federal Reserve until the battering of the Federal Reserve is completely signed, sealed, delivered, and over. He says over the weekend, there was some optimism that they gave him some comments that they won't reopen the case against him unless there's a criminal referral from the Federal Reserve's Inspector General, which there won't be since the Federal Reserve's Inspector General has already cleared Powell. But he wants confirmation that there's no intention that they're going to restart investigations, and Powell won't leave until he's assured that it's over. So he's going to stay. This is not a surprise because if he left the day after he leaves, my anticipation was that Trump would just refile a lawsuit against Powell, and then he'd have to defend that personally, and it'd kind of be like dirty. So Powell mentions he's staying as a check and balance. He doesn't want to be a shadow Fed chair. He wants to keep a low profile. And, he wants to be part of maintaining what he believes is an independent political institution. And you might not like Powell. He's certainly not been perfect. No person is. But I have to say, if you call him a politician, I don't know if you call him a politician or a bureaucrat might be the better word. He's probably my favorite bureaucrat. And it's kind of sad to sort of see him kind of like retire and fade out into the distance because I actually think he has the balls to stand up for what he believes in. Whether or not you believe he's right or wrong, I think he has the balls to stand up for it. And I really respect that. I think he's transparent. I don't think he's like an insider trader, slimeball, or corrupt, or a fraud. Like, I think those are all slanders against him. And maybe my judgment is wrong, but I think I personally think he's a great person, and I'm sad to see him leave. Maybe it's just because I've been covering him for 8 years. But anyway, so Powell's going to stay. He does get to stay until at least, if he wants, until maximally, I should say, January 31st of 2028. Donald Trump will still be in office for another year after that, so he can't wait out all of Trump's term. But he can certainly get through midterms, and that's probably where Powell, maybe before the holidays, he checks out or, whatever. But overall, Powell reiterates really that we shouldn't expect cuts until probably 2027. We have to get through these shocks, and we need to start seeing those one-time effects from the tariffs roll over the next 6 months. because they were applied in April, May, June, July, August, September, all the way through November, we should start seeing some of those year-over-year effects roll over May, June, July, all the way through November. You know, we had our Chinese tariff deal late in November of 2025. So you got to get all those numbers to roll over year over year. That's why Powell says over the next 6 months, you're going to be paying attention to those numbers rolling over. If those numbers roll over at the same time oil prices come down, then we can potentially start hinting about, rate cuts again. But potentially as soon as the next meeting, we're actually going to remove the easing bias and just go towards a neutral. We're holding until we get more data. We're going meeting by meeting, all that good stuff. So basically, don't expect any movement from the Fed anytime soon. Now, as far as rate hikes, Powell actually kind of put a bar on this a little bit. He said, we're trying to get inflation down with the least amount of damage. We don't want to do it quickly. And so we're willing to be patient because we don't want to essentially crash the labor market. To me, that was actually a very solid sign that the Federal Reserve isn't rushing to repeat the 1970s where they rapidly raise rates and this causes other problems. Some argue that actually induces inflation itself via higher interest rates, which increases costs of goods sold, which therefore increases the prices that people are charged, which is entirely possible. And in fact, even likely, how much that contributes relative to demand is obviously a question for economists to debate. But, to me, Powell implied that the bar to hike is very high. And with Warsh, it's probably also very high. So I don't think you're going to get hikes as much as people are going to clamor for that. I think you're going to get patience, especially since Powell says we're probably a little above neutral. Neutral rate's probably 3.5, and we're slightly above 3.5 right now, sitting at about, to be exact, 3.625 is where rates sit right now, right? That's between 3.5 and 3.75. That midpoint, that's roughly where we sit right now, which is like an eighth above neutral. And Powell thinks that's roughly the right place. Now, Powell's not going to be the chair anymore, but it's likely that others agree based on the voting that we're seeing and the commentary that we're seeing from others. So I actually agree with this strategy. I don't think there's a reason to rush for rate cuts at this point, especially because of what we're seeing with ADP. Now, a lot of people haven't been paying attention to ADP, but last couple of weeks of ADP, we've been averaging on a weekly basis through April 11th, 160,000 jobs created on the private ADP payrolls report. It's fantastic. Take that freaking jobs money and go join us using coupon code Goodbye Powell, expiring that tomorrow night. We're just doing a quick one for Powell here, and then we'll raise the prices again because we've got some really cool new things coming out for course members in the Meet Kevin app, the desktop version. We are developing this stuff like crazy. It's fascinating what we're building in the background. I can't wait to share it all. But anyway, this is this is broadly good. The data that we're seeing. This is why the bull bear scale moves up. Now, one thing that I've been speculating on is that I almost feel like when the bull bear scale my bull bear scale is high, but at the same time, like the greed and fear index is also high, it's not a time to buy. Like, in my opinion, a good time to buy is when this needle is at fear, or obviously extreme fear, fear or below. When this needle is at fear or below, and Kevin is above like a 6 or 7, right? Because that gives you sort of a wedge, if you will, because it means the broader market doesn't sort of align with Kevin's bullishness. I actually agree with Powell, though, where Powell argues, look, the economy's doing great. I mean, he didn't declare victory here, but he's pretty optimistic about what we're seeing, not only on spending, of course, in part driven by artificial intelligence, in large part, frankly, but also what's going on with the stabilization of the labor market. I would even go as far as calling it rebounding at this point with what we're seeing. And hopefully that continues. Obviously, things could change depending on how long the Strait of Hormuz is closed. But overall, this all felt very stable. I think he ended it on a high here, very respectable. I think he had a few mic drop moments. He argues that typically we're going to look through an oil shock. We've heard that before. But it's just a matter of time how long this oil shock continues. He's indicated that near-term inflation expectations have started to rise. That's probably due to oil prices literally skyrocketing. We're over double where we were in January. We're about double where we were in January. We were about $60 on Brent in January, and we're at about $120 now, just for the sake of exactness. Economy's holding up, resilient. Powell's happy, and I think he's leaving on a high note. I think he's done very well. And if I mean, it's a problem, obviously, that the 10-year is 4.41. It's not great. Mortgage rates going up again, but that's all right. We'll probably see higher for longer, as we've said. And anyway, if I had to give Powell a report card, honestly, I mean, he wasn't perfect, but I'd still probably give him like a 96 out of 100. It'd still be an A+. It's not 100. We know we had the little transitory oopsie doopsies. It just lasted too long, right? It led the Fed to be too late in 2022. But they acknowledged that slow reaction function. But otherwise, broadly, they've sailed this economy and directed this economy very well. I think there are still underlying issues to deal with, and Warsh will have to deal with that. His reputation doesn't make me very excited about the grade that he's going to get. But who knows? Maybe he's a changed man. So we'll see, and we'll be covering it. That's obviously my opinion. And if you want more of my opinion in terms of trades, short-term trades, medium-term trades, which would be like 6 months to a year, or long-term trades, like 10-year trades, or really investments. And even if you have questions about investing in real estate or, the stock companies you want analyzed or whatever, make sure to join us in the live streams we do almost every morning when the market is open. And right before the market is open, we do our alpha report. You go to meetkevin.com, you could join that. And we'll look forward to seeing you there. A lot of people write that off on their taxes as well as education. And folks, we'll see you in the next time. And then a quick note, since I see somebody leaving a comment here. I made some delicious bread yesterday. If you want a good bread recipe, I put it on my Instagram at meetkevin as a story. I'm actually going to go eat some of it right now because I'm really excited about it, and then we'll see what happens with earnings. But anyway, delicious molasses honey bread, whole wheat, protein, like heavy on protein. Oh, it's great. Anyway, we'll see you soon. Thanks for being here. Good luck on earnings if you're playing them. All right.